Hey there, fellow money enthusiasts. Today we're tackling the exciting world of corporate finance. It's all about how companies manage their money. Think of it as the financial engine that keeps businesses running smoothly, how they invest, raise funds, and manage operations. Imagine a company wants to launch a new product. Corporate finance helps them figure out if it's a smart move. Will it bring in more money than it costs? These are the questions corporate finance answers. It's about making strategic decisions for long-term success, but it's not just about big decisions. Corporate finance also deals with the nitty-gritty. How much cash should a company keep on hand? What's the best way to collect payments from customers? It's about sweating the small stuff to keep the financial wheels turning. Understanding corporate finance is crucial. Mastering it will give you a serious edge in the world of finance. Stay tuned as we break down the key concepts and players in this exciting field. Let's talk about the financial manager, the mastermind behind a company's financial health. These folks are like financial architects, designing and executing plans to ensure the company thrives. They're responsible for making sure every dollar is working hard. What exactly do they do? Well, their job description is pretty extensive. They analyze financial data, develop budgets, and recommend investment strategies. They're also in charge of managing risks and ensuring the company has enough cash flow to meet its obligations.
Think of us as the conductors of a financial orchestra, making sure all the instruments are in tune and playing together harmoniously. We work closely with other departments, providing financial insights to guide decision-making. The role of a financial manager is crucial, especially in today's dynamic business environment. We need to be adaptable, strategic, and have a deep understanding of financial markets. It's a challenging but rewarding role, playing a vital part in a company's success.
Meet the big players in corporate finance, the CFO, treasurer, and controller. These three form a financial powerhouse with unique responsibilities. The Chief Financial Officer, CFO, is the head of the finance department. They ensure the company's financial health and stability. The treasurer manages cash flow, investments, and debt. They ensure liquidity for smooth operations. The controller handles financial reporting and compliance. They keep track of transactions and prepare statements. Together, they ensure financial stability and drive growth. Imagine a company wants to invest in a major project, like building a new factory or developing a cutting-edge product. That's where capital budgeting comes in. It's the process of planning and evaluating these long-term investments. Think of it as financial planning for the future. Companies need to carefully analyze potential projects, estimating costs and projecting future cash flows. They need to determine if the investment will generate a positive return and contribute to the company's growth. There are various techniques used in capital budgeting, such as net present value, NPV, and internal rate of return, IRR. These methods help companies compare different investment opportunities and make informed decisions. Capital budgeting is a crucial aspect of corporate finance as it directly impacts a company's long-term success. By making strategic investments, companies can expand their operations, develop innovative products, and stay ahead of the competition. Section 5, Capital Structure, Debt versus Equity. Every company needs money to operate, but where does that money come from? That's where capital structure comes into play. It refers to the mix of debt and equity a company uses to finance its operations and growth. Debt is essentially borrowed money that needs to be repaid with interest. It can come from bank loans, bonds, or other forms of credit. Equity, on the other hand, represents ownership in the company. It can be raised through issuing stock or retaining earnings. The choice between debt and equity financing has a significant impact on a company's financial risk and return profile. Debt can be cheaper, but it also increases financial leverage and the risk of bankruptcy. Equity is more expensive but provides a cushion against financial distress. Finding the optimal capital structure is a delicate balancing act. Companies need to consider factors such as their industry, growth prospects, and risk tolerance. The right mix of debt and equity can maximize shareholder value while ensuring financial stability. Section 6, Working Capital Management, keeping the engine running. Let's move on to working capital management, which focuses on the day-to-day financial operations of a company. Think of it as keeping the engine running smoothly.
It involves managing current assets such as cash, inventory, and accounts receivable, and current liabilities like accounts payable and short-term debt. The goal of working capital management is to ensure the company has enough liquidity to meet its short-term obligations while maximizing the efficiency of its operations. This involves optimizing inventory levels, collecting receivables promptly, and managing payables effectively.
Efficient working capital management is crucial for a company's financial health. It frees up cash flow, reduces the risk of financial distress, and improves profitability. By streamlining their working capital cycle, companies can operate more efficiently and achieve their financial goals. Section 7, Business Organizations, choosing the right fit. When starting a business, one of the first decisions entrepreneurs face is choosing the right legal structure.
The most common forms of business organization are sole proprietorships, partnerships, and corporations. A sole proprietorship is the simplest form, where the business is owned and run by one person. It's easy to set up, but the owner has unlimited liability, meaning their personal assets are at risk.
A partnership involves two or more individuals who agree to share in the profits or losses of a business. Like sole proprietorships, partners typically face unlimited liability.
Corporations, on the other hand, are separate legal entities from their owners, offering limited liability protection. This means the shareholders' personal assets are protected from business debts and lawsuits. However, corporations are more complex to set up and manage.
The choice of business organization has significant legal and tax implications. Entrepreneurs need to carefully consider their needs and circumstances when deciding which structure is right for them. Section 8, the name of the game, maximizing shareholder wealth. What's the primary goal of a corporation? In a nutshell, it's to maximize shareholder wealth. This means making decisions that increase the value of the company's stock over the long term. Shareholders are the owners of a corporation, and their investment is reflected in the stock price. When a company makes profitable investments, manages its operations efficiently, and generates strong financial performance, its stock price tends to rise, rewarding shareholders. While other goals, such as corporate social responsibility and employee satisfaction, are important, they should ultimately contribute to maximizing shareholder value. After all, shareholders are the ones who have invested their capital in the company, and they expect a return on their investment. Maximizing shareholder wealth should be the guiding principle behind all corporate decisions. It ensures that companies are focused on creating value for their owners and driving long-term financial success. Section 9. Agency relationships, aligning interests. In a corporation, there's a separation between ownership and management. Shareholders are the owners, but they delegate the day-to-day running of the company to managers. This creates what's known as an agency relationship.
The problem is, managers may not always act in the best interests of shareholders. They might prioritize their own self-interest, such as pursuing personal gain or empire building, which can lead to conflicts of interest. These conflicts can result in agency costs, which are the costs incurred when managers don't act in the best interests of shareholders.
These costs can be direct, such as excessive executive compensation, or indirect, such as missed investment opportunities. To mitigate agency problems, companies implement various mechanisms, such as corporate governance structures, executive compensation plans tied to performance, and independent board of directors. These mechanisms aim to align the interests of managers with those of shareholders. Section 10. Motivating managers, incentives, and more. So, how do you motivate managers to act in the best interests of shareholders? It's all about creating the right incentives. One common approach is to tie executive compensation to company performance. This can include stock options, bonuses, and other incentives that reward managers for increasing shareholder value. But it's not just about money. Companies also create a culture of ownership by giving managers more autonomy and responsibility. When managers feel like they're part of something bigger and have a stake in the company's success, they're more likely to make decisions that benefit all stakeholders. Another important factor is transparency. By providing shareholders with clear and accurate information about the company's financial performance and strategic direction, companies can build trust and reduce the risk of agency problems. Motivating managers is an ongoing process. By creating the right incentives, fostering a culture of ownership, and promoting transparency, companies can ensure that their managers are aligned with the goal of maximizing shareholder wealth.